month when I get paid, I add to my investments. In this video, I'll walk you through the accounts I used, the investments I made, and why I chose them. If you'd like to stay updated on my investments and portfolio performance, make sure to hit subscribe. Now, let's get into it. The approach that I take when it comes to investing is long-term. My plan is to stay invested for decades, and I invest in a mix of index funds and individual stocks. Each month, I contribute to two types of accounts that are tax advantaged in the UK. The first is a self-invested personal pension, or SIP. I'm self-employed and don't get a workplace pension, so this is effectively it for me. The second account I use is a stocks and shares ISA. This allows me to invest without having to pay tax on any gains or income, and crucially, doesn't lock away my money, unlike a pension, which does lock your money until age 55. That age is set to rise to 57 from 2028. Let's start with the investments I made within my SIP because it's going to be pretty quick. That is because I have my SIP with Vanguard and I only invest in one fund, the Vanguard FTSE Global All Cap Index Fund. This is a global index fund that covers thousands of small, medium, and large companies worldwide. I like it because it spreads my risk across companies of different sizes, industries, and crucially from lots of different countries. Now let's move on to the investments I made within my stocks and shares ISA, which is with Trading 212. If you watched February's investments video, you'll know that last month I only invested in index funds within my stocks and shares ISA because I didn't have time to research any individual stocks. And that's the beauty of index funds, really. They're very hands-off because they essentially just track the performance of the stock market as a whole. The creator of the index fund and the founder of Vanguard, John Bogle, has a very famous saying that goes like this: "Don't look for the needle in the haystack, just buy the haystack." And that's very good advice, which I follow for the most part. I do have most of my investments in index funds, but I do like to invest in some individual stocks that I think have the potential to outperform the market over the long term. I might be absolutely wrong with that statement, by the way, but I guess only time will tell. Now, this first stock I invested in is a company that I've owned for years and years, and there have been some bumps in the road, although few more painful than this current one. At the time of recording, shares of this business are down more than 40% in the space of a couple of weeks, after reporting some disappointing results. That business is the Trade Desk. And this month, I invested £775 in its stock. Let's talk a bit about what the company actually does. The Trade Desk is a programmatic digital advertising company, meaning it automates the buying and management of digital ads across websites, apps, and streaming services. Advertisers set their budget and targeting preferences, and the Trade Desk's platform instantly finds the best places to show their ads using real-time bidding. This makes ad spend more efficient by leveraging huge amounts of data to target the right audience and adjust campaigns in real time. For advertisers, it means better results. And for investors like me, it means a company with a brilliant co-founder CEO at the center of the shift toward automated, open, data-driven advertising. There's a rare few companies in mine and Jamie's portfolios where we've always said the second that shares don't look expensive, we need to buy them because they are high-quality businesses. And the Trade Desk was always one of these, so this month it was time to put our money where our mouths were. Still, why have shares fallen by over 40%? The short answer is poor results. Every 3 months, some companies, like the Trade Desk, tell investors how much revenue they think they'll bring in over the next 3 months, known as the next quarter. This is referred to as guidance. Now, the big shock this quarter was that the Trade Desk's revenue was below the guidance they had given us last quarter. And this was actually the first time it has fallen short of its own guidance in over 8 years. So that's the headline. But the big thing for investors to understand is why this happened, what management are doing about it, and if it indicates a broader problem with the company. The good news is that the Trade Desk still dominates the open internet advertising space with its AI-powered platform Kokai, helping advertisers to target the right people with precision and efficiency. One of the big reasons for the revenue miss this quarter was that the Trade Desk delayed the full rollout of Kokai, which had been planned for a full launch in Q4, basically because they weren't completely happy with the platform. CEO Jeff Green said it wasn't due to any fundamental flaws, but rather final refinements in its AI-powered forecasting, enhancing the user experience and performance modeling. As a result, the company decided to run 2 parallel systems, Kokai and the older Solimar, which created inefficiencies and impacted near-term growth. Basically, the company had 2 choices. Either launch a product that still needed refining in order to hit short-term quarterly goals, or delay the full launch in order to ensure that the final platform was as good as possible. They opted for the latter, which caused some short-term pain, but is probably the better choice of the two. As co-founder and CEO Jeff Green said, in Q4, there were a series of decisions we could have made to enhance the short-term performance of the company and neglect the long-term. We consistently choose to focus on the long-term opportunity and maximize our market share over the long-term. And this is exactly what we want to hear as long-term investors. Don't get me wrong, this was still a misstep by the company. But importantly, Green acknowledged this. He said, for Q4, the reality is we stumbled due to a series of small execution missteps while simultaneously preparing for the future. The latter refers to the fact that also in the previous quarter, the trade desk made the largest reorganization in the company's history, expanding its leadership team, optimizing its product development, and focusing more on direct brand partnerships. While these moves were already in the works, they were accelerated and expanded in response to the missteps from the Kokai rollout. Green framed this as a necessary recalibration to prepare the company for even bigger opportunities ahead. So, what's the takeaway from all of this? Well, I think every disruptive, fast-growing company, no matter how brilliant, will have bumps in the road to success, because it's not a straight path up. But Jamie and I have said time and time again, mainly on our podcast to be fair, that the trade desk is one of the best businesses in our portfolios, and that Jeff Green is probably the best CEO of any company in our portfolios. If there is one CEO that has earned our trust over the years to steer the ship in the right direction, it's him. So, was this a bad quarter? Yes. Were shares a bit expensive beforehand? Also yes. Is this company 40% worse than it was a few weeks ago? Absolutely not. I have to say, we've seen some crazy reactions to company results over the years, but this is one of the ones that we understand the least. We expect the shares to fall, but a 40% drop just feels way overdone. This is why I made a substantial investment into the trade desk. I invested £775, which increased my investment in the company by about a third. And these days, I rarely invest that much into a company at once. Sadly, I can't predict the future, but I feel very confident that in 3 years' time, I look back on this investment with a lot of happiness. As always, only time will tell, but that was my first and most substantial ISA investment this month. Now, my other ISA investment this month was £375 put into my global pie, which I actually spoke about in last month's investments video as well. As a reminder, my global pie is made up of 2 global index funds. By investing in this one pie, I get instant diversification across thousands of small, medium, and large companies across the globe. It also invests passively, meaning it basically tries to copy the returns of the world's stock market rather than try to outperform it. Previously, the pie was split in the following way. 92.5% of my investment went into the Invesco FTSE All World ETF, ticker symbol FTWG. The remaining 7.5% of the pie was invested in the iShares MSCI World Small Cap ETF, ticker symbol WLDS. However, I recently became aware of a potentially better option for my main global index fund, the Spider MSCI All Country World ETF, ticker symbol ACWI. It's an ETF that had been mentioned to me a few times across our YouTube, our Instagram, and even our podcast. And I finally got the chance this month to sit down and properly take a look at it. And after looking into the Spider MSCI All Country World ETF in more detail, I realized it had 2 major advantages over the Invesco one. First, it recently cut its fee from 0.4% to 0.12%, making it one of the cheapest global index funds available, and also explaining why it hadn't come up on our radar before, because previously it had been quite expensive. This new fee of 0.12% is lower than Invesco's fee of 0.15%, which might not sound like much, but over a long period, those small percentage differences can add up significantly. A rough calculation showed that assuming I invest on average £500 a month in these funds, and they both return the long-term average return of global stocks, I could end up with over £14,000 more thanks to these lower fees by the time I reach retirement. And that is actually why I use a low-cost investing platform like Trading 212 for my stocks and shares ISA as well, because it means I can keep more of my hard-earned money. By the way, our viewers can use promo code SNSBonus to get free fractional shares up to £100 when they join Trading 212. This is an affiliate code, meaning that we get a small payment which helps support our free content. Now, the second advantage is that the Spider SPDR ETF is actually a much larger fund, managing over $4.6 billion in assets compared to only $1 billion for the Invesco ETF. This might seem like a meaningless number that fund providers use for an asset measuring contest, but in practical terms, the larger fund means better liquidity. Or put simply, it's easier to buy and sell the ETF without big fluctuations between the price that you see on your investment app and the price that you end up paying. This difference isn't a big deal for small investments, but as my portfolio grows, I want to be invested in funds that can handle larger investments smoothly without any unexpected price jumps. It's also worth noting that SPDR funds are issued by State Street Global Advisors. It's important to go with reputable providers for any ETFs. That's why we've gone for the likes of Vanguard, Invesco, and iShares by BlackRock in the past, just to name a few. Now, State Street Global Advisors are less well known here in the UK, but that doesn't mean they aren't reputable. In fact, they are very reputable. They are actually the third largest ETF provider in the world, behind BlackRock and Vanguard, with over $1.5 trillion in assets under management. So after thinking it through, I made the switch. I sold the Invesco FTSE All World ETF, and I bought the SPDR MSCI All Country World ETF in my global pie, while keeping my 7.5% allocation to the small cap ETF as well. It wasn't a dramatic change, just a small tweak to reduce costs and improve efficiency, but over time, it could make a meaningful difference to my returns. And that's really the point of a hands-off investment strategy in global index funds like these. You don't need to constantly chop and change your strategy, but when an opportunity arises to improve something without adding extra risk, it's worth considering it. This also reinforces why I always encourage checking your investment fees regularly. Providers do change their fees from time to time, and newer, cheaper options sometimes become available. I wouldn't recommend obsessing over every tiny cost difference, but if you can make a smarter choice that could save you thousands over the years, it's worth the 2 minutes that it takes to switch. A simple adjustment today could mean an extra holiday, a bigger house deposit, or even retiring earlier down the line. So my investment was £375 in my global pie, but it turned out to be a bit more of an exciting month for my global pie than usual. That's a wrap on my investments for this month. If you're curious, Jamie, my fiance, and the other half of this channel will post his monthly investments next week. So if you want to see that and you'd like to follow along with our investing journeys, don't forget to subscribe. Thanks for watching, and I'll see you next time.